Alright, we're now in part 2 of the presentation, starting on slide 25, and this slide actually captures what I was trying to show on the whiteboard in a much less sophisticated way just before we broke off the first part of the presentation. So using the T accounts and showing what happens with adjusting entries for prepaid expenses, you can again see that the asset account, which would be something like office supplies or insurance, would have an unadjusted debit balance until month end, at which point a credit would be made, an adjusting entry, based on the office supplies used, the amount of insurance coverage used up, whatever the case may be, and then that amount would correspondingly be debited to the related expense account, office supplies expense, insurance expense, again, whatever the case may be. So it increases or debits an expense account, and this adjusting entry decreases or credits an asset account. Alright, on slide 26, here's an example showing the adjusting journal entry and the related postings to the affected accounts. As stated in the example, a month-end inventory revealed that $1,000 of items remained. Therefore, $1,500 of the original $2,500 balance was used up. That is why an adjusting entry debiting an expense for the $1,500 used up and an associated credit reducing the asset account supplies needs to be made. And you can see there not only the journal entry, but the postings to the appropriate accounts, both on the credit side for supplies and the debit side for supplies expense. Slide 27. The entry here recognizes that 1/12 of the insurance coverage was used up during the month, so 1/12 of the total asset cost of prepaid insurance needs to be expensed via an adjusting entry, which debits the insurance expense account and credits the prepaid insurance asset account. And again, you can see the associated postings to the general ledger for those individual accounts of prepaid insurance, the credit of $60, and insurance expense, the debit of $60 associated with that. On slide 28, and here depreciation is an estimate based on the asset's estimated useful life of how much of the asset's cost was consumed during the period based on the depreciation calculated for each period from its useful life estimate. You can see that buildings, equipment, and motor vehicles are examples of long-lived assets that are recorded as assets rather than expense in the year acquired. And then they report a portion of the cost of the long-lived asset as an expense during each period of the asset's useful life, as it says on the slide. Slide 29. Note in this example that although we were recording an adjusting entry for depreciation on office equipment, the office equipment account itself is not directly affected. Rather, the debit is to depreciation expense, and the associated credit is to this account called accumulated depreciation, which is a contra asset account with a normal credit balance. Remember, in the financial statements, specifically in the balance sheet, accumulated depreciation is subtracted from the property, plant, and equipment balance to derive the net PP&E balance after depreciation. On slide 30, this slide illustrates how the accumulated depreciation on the equipment asset is presented. Remember that it is a contra asset account and therefore has a credit balance, and that is why it is subtracted from the asset's balance to obtain the net of depreciation balance that is shown in red on the slide of $49.60. Excuse me momentarily. Alright, on slide 31, this slide shows why the adjusting entries for prepaid expenses need to be done. Some of the prepaid expenses, that is assets, were used during the period, and this causes an expense to be incurred. So if we do not perform the adjusting entry, then assets will be overstated on the balance sheet and expenses will be understated on the income statement. Note that on the balance sheet, stockholders' equity will also be overstated since net income will be overstated. Thus, the failure to record the adjusting entry does not in itself cause an imbalance in the basic accounting equation, or overall debits or credits for the period, but it still makes it so the financial statements are basically wrong. On slide 32, this slide focuses on adjusting entries for unearned revenue, another deferral situation. In this case, the company has received cash in advance for a product or service that it has yet to deliver and will not deliver until a future period, at which time revenue will be recorded and the liability will be reduced. This slide shows some examples where an unearned revenue situation can occur: rent, airline tickets, magazine subscriptions, customer deposits. Slide 33, so when we get to the period in which the product or service was delivered and the revenue was therefore earned, an adjusting entry is needed to record the earned revenue and reduce the related unearned revenue liability account by whatever the amount earned is. Note that the entry involves a debit to the liability account, which reduces its balance, and a credit to the revenue account, which increases its normal credit balance. So let's stop right there for a moment and key account what this looks like. Keep the numbers simple here. So we have the unearned revenue liability account that has a credit balance of $1,000 at the beginning of the period. $500 of that was actually earned during the period, which means we need to then debit this account for that $500 that was earned, which will leave it with a balance, a credit balance again, of $500. And on the other hand, the revenue account, the sales revenue, is going to be increased or credited by that same $500, as you can see there. Slide 34, on this slide we see the T account version of what we just discussed. So again, they're showing it in a little bit more sophisticated way than I am. But just to hammer home that point, it shows the effect of the adjusting entry to recognize some revenue for the product or services delivered during the period, therefore reducing the liability by debiting it, increasing revenue by crediting it. Okay, slide 35. Here's an example showing the journal entry and the related postings to the affected accounts. Note that the company analyzed how much of this service had been provided in October and then made the adjusting entry to recognize the revenue earned and decrease the unearned revenue count accordingly. Slide 36, as with the prepaid expenses adjustments, this slide shows the reasoning for the unearned revenue adjusting entries for revenues earned and the impact on the balance sheet. That is, liabilities would be overstated and the income statement revenues understated if we didn't make this adjusting entry. Note also that understatement of revenues impacts negatively on the retained earnings balance, since net income too will be understated, which in turn means that overall stockholders' equity is understated. Note also how the overstatement of liabilities and the understatement of stockholders' equity would keep the basic accounting equation in balance. So you cannot tell anything was wrong simply by looking at the accounting equation. You'd have to dig a little bit deeper. Okay, on slide 37, I just ask you to see page 223 for further discussion and the answer to the question on this slide. And keep in mind the revenue recognition principle. That is, did Best Buy earn the revenue when it sold the gift card, or only when it provided goods or services in exchange for the gift card? That's a little food for thought there. Slide 38, adjusting entries for accruals versus deferrals involve entries to recognize revenues or expenses earned or incurred in the period but not yet recorded, and probably have not put out or received cash yet. Slide 39. As can be seen on this slide, in the instance of accrued revenues, the revenue is recorded before cash is received. The slide notes several potential examples of this with rental income, interest income, or services performed. So on slide 40, the adjusting entry for accrued revenue affects both a revenue and an asset account, in recognizing that a receivable exists and that revenue has been earned. So again, in a situation like this, we have made a sale, we haven't received cash for it, we might not have even invoiced for it yet. And let's say it's $500. I apologize for my sloppy handwriting here, but what we've got, we made a sale for $500, did not receive cash for it, maybe didn't even invoice for it yet, but it occurred before the end of the period. We need to recognize that with an adjusting entry to debit accounts receivable, which is an asset account, for $500, credit sales revenue, a revenue account, for that same $500. So moving to slide 41, to emphasize with the use of T accounts, again, the chart shows the posting of the debit to the asset, normally accounts receivable, and the credit to the revenue account that normally has a credit balance. On slide 42, note that in this case clients were not billed for the services by month end. However, that does not change the fact that revenue was earned by the company providing the services during the month in question. The slide shows both the journal entry and the related postings to the relevant accounts receivable and service revenue. On slide 43, we see again the reasoning behind the adjusting entry for accrued revenues and the impact of a failure to make such entries. That is, assets will be understated and so will revenues, which ultimately affects retained earnings and stockholders' equity negatively. Thus, failing to enter this adjustment does not in itself throw the basic accounting equation out of balance. This is the same we've seen with the other examples. Slide 44, accrued expenses work in a similar manner to the accrued revenues. In this case, an expense is incurred prior to paying for it. Some examples are shown here. Rent, interest, taxes, and salaries are some of the more common expenses for which an accrual adjustment will need to be made. On slide 45, for accrued expenses, an adjusting entry not only recognizes the expense in the period incurred, it also records the related obligation or liability. Remember, regarding the impact of a transaction on the basic accounting equation, that an increase in an expense ultimately decreases retained earnings, part of stockholders' equity, since it causes a reduction in net income. At the same time, recording a credit to a liability account increases liabilities by the same amount as the decrease in stockholders' equity, maintaining the equation's balance. And with that, this will conclude part 2 of the presentation.